Well, good morning, good afternoon, and a very warm welcome to today's executive dialogue on the World Insurance Sigma Report for 2024. My name is Anthony Kennaway, and I'm the head of Group Public Affairs here at Swiss Re. And I'm joined today by a panel of experts to help us talk through the World Insurance Sigma. First of all, the Group Chief Economist and Managing Editor of the Sigma Reports, Jerome Haegeli, our Chief Underwriting Officer for the Corporate Solutions business, Kera, McDonald. And finally, online, we have Tamas Bown, who is the head of Life and Health Reinsurance for the UK and Ireland and the Middle East and Africa. So a very warm welcome to you all. And today we're going to explore what we expect in terms of premiums, profitability and investment returns across different businesses and markets for the year ahead. We'll do that for about the next 30 minutes. And then after that, there'll be a chance for you, the audience, to ask your questions. So if you'd like to ask a question, please just use the QR code that you can see on your screen now, or go to go to slido.com and use the hashtag WIS 2024, WIS 2024, and you'll be able to ask your questions. So we're looking forward to those just towards the end of our session. So without further ado, let's come to you, Jerome, and just give us the first of all, just give us the headlines for the World Insurance Sigma 2024.
Thanks very much. I'm very happy to do so. I've prepared a few slides. Let me show you the slides in terms of the key takeaways from our World Insurance Sigma report. Number one, if you think about where we are today, growth is still resilient. I'm speaking about economic growth, both in the US, especially in the US, has been more resilient than the beginning of the year. Also, global growth is resilient. And Europe, growth in Europe, and you see here our forecasts, our Swiss Re Institute forecasts, growth in Europe is picking up, but it's still nowhere where it should be. But still on the growth side, it's not a bad environment. Actually, it's a pretty good environment. Second, if you look at where we are on the inflation front, we see the disinflation progress continuing. And that's really, really good news. However, we shouldn't forget the price shock is still in the system and we will remain in the system. We are very confident that economic inflation in Europe comes down to the 2% inflation target of European Central Bank. For the Fed, it will take a little bit longer. Notwithstanding further supply chain shocks or other geopolitical risk events, I think we are on a very good course. And third, the global easing of monetary policy has started, and the Fed this month, in the month of September, will also continue to cut. And this, I think, gives also assurances on the growth front that the risks that growth slips through the cliff is contained. This being said, we also have to think about the risks out there, and the risk number one remains, in our view, the geopolitical risks. Now, what this means for insurance market premiums, if you look at what it means for insurance market premiums, if you take both life and non-life together, and you see it with this slide, you see real premium growth for life on the left-hand side and non-life and the P&C on the right-hand side. For both, it's close to trend growth, and especially for the life, it's really interesting times ahead. We see a real turnaround with the higher interest rates, which are here to stay, turnaround in premium growth and here to stay. And if you look at our projections from the Sigma, fact is 10 years out, we expect actually that advanced economies actually contribute 50%. Think about that, just 50% of the additional premiums in the life industry. In the past, that was less than 10%. So that's really turnaround. On the P&C front, I would also mention, obviously, that profitability has improved, as we all know, at the same, which reflects in higher return of equity. This being said, the cost of capital has also increased. And if you look at the situation in the US actually, we find that, and it's also in the Sigma report, that the cost of capital is still slightly higher than the return on equity, which in my view speaks for continued hardening of the market. Now, translating what it means macro and insurance front on a different level, just looking at the factors, and you see that with the table on the left-hand side. If you look at the various factors I spoke about, be it GDP, be it inflation, be it interest rates, or also labor markets, these are all factors which speak for stronger insurance markets. Maybe the disinflation impact or disinflationary process we are seeing playing out has less of a positive impact for life insurance markets, but it doesn't have a negative impact. I spoke about the global environment being actually pretty good, and that is the case for our baseline. I also mentioned the risks being still to the downside related to the geopolitical risks. I just want to mention one more point, which I think is often overlooked. We always focus, and rightly so, on headline figures. However, if you look at the graph on the right-hand side, what you see here is real GDP per capita. What we take here is GDP growth adjusted for population. And what you see actually is for the UK, for Canada, as well as for Germany, you have contracting real GDP growth, meaning living standards are decreasing, which on the one hand, I think speaks for more resilience that our industry can bring. But on the other hand, I think it should also make us cautious about the outlook overall and not just be too much focused on the headline figures. Now, quick summary on what have been mentioned. Global growth, number one, yes, expected to remain resilient. However, downside risks prevail, and we should also not forget how financial markets are priced. Financial markets are priced to perfection. And number two, the higher interest rates environment is here to stay, and it's a real regime shift, and it's really positive for society. Finally, income, you have a return again. And I think that's also not just positive for the life industry, but also positive of how the markets are functioning. And last point on the underwriting cycle, I still think it's continuing kicking, and it is alive.
So, Kera, if I could come to you on that. So, corporations, what's on their mind, and what are they looking at the moment?
Yeah. So, I think really there's a changing landscape that the corporates are all dealing with, and I can step through a few of those. But really, the answer is the risk landscape. It's evolving, and that rate of change is speeding up, and all of these things are happening all at once, and that's really kind of where we work with a lot of our customers in order to try to understand what they're up against in order to understand how we can help them. And really, I think some of the things that are at the top of their mind, right, is increase of severe weather events. These are, it says convective storm here, but this is also hail, it's wildfires. And the rise of the secondary perils is very significant in both the frequency that we see, and then in some cases, the severity as well. And that is really driving a lot of the nat cat risk that's out there. And if we take a look at how big of an impact is that, it's, we say relative to GDP, the natural catastrophe loss load, it has grown, it has doubled in the last 30 years. And this 5 to 7% that's listed here on the screen, it's a little hard to put it in context without that. It actually means that relative to GDP is going to double again in the next 10 years. So it's getting faster, right? And that's we can see that. You match that up with the increasing loss of risk because of the inflation that Jerome was talking about. Both economic inflation and social inflation, it's hitting all of the kinds of coverage that our clients are out there buying from us, but the risks that they're facing. You include that with then geopolitical. There is a heightened geopolitical tension across the world today, and that really comes through in their, I'd say, their concern around the shocks that can come with that, both resource price shocks, the chance of strike, riot, and civil commotion, the incidence of that. Whether you see it through France in 2023 or Black Lives Matter in the United States back a couple of years ago, these are all events that are of concern to our clients. This is all in the atmosphere of just we are a more interconnected world, multinational needs, multinational coverage, and that means that they have supply chain dependencies that span across many jurisdictions, and I think really a lot of what we saw during COVID, it was, our clients were talking about the security of their supply chains. They were talking about making sure that they had, redundancies in that. These days, they're talking about making sure it's cost efficient again, and that stretches their supply chain, which then makes it very important to really help work with them in order to see where those weaknesses are. Rapid technological shifts. I mean, it used to be the Internet of Things. It was about things talking to each other. These days, with artificial intelligence, it's about things not even needing to talk to each other anymore, which is a whole new landscape, and it's changing incredibly quickly. And then ESG, right? The really regulated or scrutiny, the changing perceptions of society around ESG transition. These are all things that our clients are dealing with every day.
So huge issues then. How are you helping them at Corporate Solutions?
I have a slide for that, right? Really, it's about, for us as insurance, to work with our clients in order to really, both in their ESG transition, right? I mean, they know their business better than we do, obviously their core business, but what are the risks that are out there as far as changing weather that goes with it out into the future? Regulatory reporting needs, things like that, that we work with them. It's about leaning in and understanding what solutions we can help spread across the insurance industry. It's around alternative risk transfer. Really, this is around many of the large corporations today. For them, it becomes a fine tuning of what risks would they rather retain themselves and what would they rather transfer to the insurance industry, helping them understand their options in that. International programs, really offering a seamless coverage that really orchestrates those policies across all the jurisdictions they work in. And then really taking a data-driven, pricing approach. This comes to a new sustainability of, I think we've all seen a catch-up of some of the pricing that happened in our industry over the last couple of years because of the fact that the insurance industry was not making its cost of capital, right? And so there was this catch-up for all of these various risks that happened. So now we need to really try to make it as accurate as possible in order to keep up with these trends and be transparent to the clients about what is driving those trends, and then work with them, risk engineering, to help mitigate those.
All right, thank you, Kera. Let's move over now to Tamas and to the life and health insurance sector. Tamas, tell us a little bit about what this means for life insurance as well, the World Insurance Sigma, the report that we've got just now, and sort of what that means also for social resilience.
Yeah, thanks, Anthony, and hello here from London. As you heard from the comments earlier on, really the life and health outlook is even on the rosier section that we see. So the increase in global life insurance premiums from 4.7 trillion, up from only 3.1 trillion today. So over 10 years, that's not to be sniffed at. Now, of course, some of this comes from just the increase in GDP and the consistent increase in life and health business you'd expect. But I think also really importantly that does within that include an increase in penetration, an increase in the emerging markets as they move up the S-curve, and an increase in the importance that advanced markets have within that. Now, you heard earlier mentioned that 50% of that growth expected to come from advanced markets versus only 9% in the decade after the GFC. So this is a very significant change, and really the advanced markets for life and health coming back to play a really key role. Now, top line alone, of course, doesn't indicate the health of a sector. What's really impressive to see is approximately a 15% increase in the sector profitability, and about 14% of that comes actually from investment income. So as you'd expect with long tail lines, very large capital stocks built up, large reserves, you would expect to see that in a new era of higher interest rates that life and health would be a rosier picture. And that really makes most difference on the savings and retirement side. So from savings business, really higher rates are meant to encourage society to save more. They're rewarded for that. And in many different markets, actually, the main vehicle for savings is encouraged to be through the life insurance sector rather than purely through banks and asset management, for example. So that's key to see. Also on the pension side, of course, from an annuitization perspective, policies look much more cost effective in a higher interest rate environment. So it's also easier to sell. So I think all round we're expecting that to be a significant improvement. So that'll help close some of the savings gap, some of the retirement gap, and also help improve household resilience against some of these life and health risks.
That's great, Tamas. Thank you very much indeed. And just for the audience, just to remind you that if you'd like to ask a question, you can do so at slido.com and just put in the hashtag WIS2024. In the audience, Tamas, I know we've got a number of people from your markets of the UK and Ireland, but also Middle East, Africa. Give us a bit more detail on those particular markets then, please.
Thanks, I will, Anthony, and maybe starting with the UK. And I can give an example of what we're seeing, what our outlook looks like, both on the rosiest side of the forecast, but also on the areas that are still a little bit challenging, because you'll have noted in my comments before, I was highlighting where the increased interest rate environment is particularly good for savings and retirement. It has less of a leveraged effect on protection business, and we do see some of those kind of challenges in the UK. So when you have a tougher cost of living environment, higher interest rates can actually work in a contrasting direction for protection business. So particularly where it's credit related, it makes credit harder to obtain, drives up the cost of mortgages. So in an environment where a lot of the sales for protection business take place within that space, it actually makes it quite challenging. In fact, we saw, so Swiss Re releases a term and health watch each year, and we saw for the market results last year actually a drop of about 5.5% in terms of policy sales overall for protection business, and a lot of that is driven by those factors. So we still see the positive chance for an outlook for the market to grow, but it won't have as leveraged effect as it does for savings and retirement. On the latter, however, we saw the opposite for 2023 was a bumper year for pensions risk transfer. So particularly in the bulk space, so bulk pension annuities, where pension schemes are de-risking and transferring that to the insurance markets, it reached approximately 50 billion present value of liabilities transferred to the insurance market. That's a huge number. This year, maybe slightly slower, but still expected to be very large, perhaps 40 billion or thereabouts. And we expect a lot of that to continue. So that will be one of the largest areas of growth. Going wider from the UK, it's not limited to the UK. Of course, there are many markets that are starting to see an increase in pensions risk transfer. Some of the North American markets, Netherlands, another significant example. Maybe to contrast with that, well, a partial contrast. If you look towards our Middle East Africa markets, from a life insurance perspective, the largest one of those is South Africa, and of course we would describe it as an emerging and developing economy. But from a life insurance market perspective, it's really quite mature. So mature products, very mature clients, very high market penetration. For those who picked through the appendices, the back of the World Insurance Sigma, you'll have seen that it's the second highest in the world for insurance penetration on the life and health side. And actually it follows some of the same dynamics we've seen recently on the macro side for the UK. So say 21 to 23, the same kind of pattern of increasing inflation, driving cost of living challenges, but now that coming down to a sustainable level. And similarly on the interest rate side, so increasing over that time, perhaps now getting to a stage where it's plateauing now. So we'll actually see some of the same opportunities and challenges. And then maybe lastly, rounding off in the Middle East, so huge opportunity for growth there. A lot of those life insurance markets are still in the developing stages. So a lot of health business, group business, starting to see some of the more advanced savings accumulation, but still a lot of area to grow. Of course, we'd be remiss not to mention the dampeners on that are faced by conflict in the region, political and passive and active war risks.
Okay. All right. Thanks very much, Tamas. Thank you very much indeed. Just give us a last question to you, Tamas, if we may, please. Just give us a sense of the overall disposition of the clients. What are the things that they're most optimistic about, and the things that perhaps they're most worried about?
Yeah, maybe a good example on both sides. I won't touch on the opportunities around savings and retirement again. I think I've covered that. I'd say globally, but certainly is the case in the UK. Health is going to be a key space that the markets are quite excited about. So you've seen a lot of the challenges occurring around the world about on the healthcare, state-provided healthcare side. So some areas where there's been a bit of a lack of capital investment, difficulties with staff shortages, increasing awareness from the public, aging demographic, and a significant inflation in treatment costs all mean that there's space for more private healthcare there, and there's increased opportunities for clients to work on solutions to that. So the private sector has a big role to play in that space. So on the health side, I'd see that as an opportunity. So within that future growth that we're forecasting, maybe to contrast with that, what's an area which I think overall big picture is an improvement, but it certainly gives a challenge to a lot of our clients in the insurance industry, are the changes to regulatory and reporting standards. So globally, this could cover a variety of different things, but in many markets, you'd say the move to IFRS 17 is a significant one. So whilst often these changes do sometimes add to convergence, and they also increase transparency and help portray life and health business in a positive light, they've been significant burdens of administrative process for the last few years, significant expense drains, and so I'd expect that that a lot of insurers around the world are now in a place where they're more comfortable, that they're in a new regulatory and reporting regimes, and they're starting to transition their thinking on that from it being a reporting and administrative exercise to something which really starts to drive strategy. So I think that's an area to watch, but also something that will give rise to opportunities.
All right, thanks a lot, Tamas. Thank you very much indeed for that. And Kera, if I could come to you very briefly, just to talk about sort of the main preoccupations of your clients, perhaps the things they're most optimistic about, perhaps the things they're not so optimistic about.
Well, when I talk to my clients, really, I think there is a strong economy out there that they are all taking part in. And that's exciting for them. I think if you talk to them about the insurance industry, right, I think we are all aware that there has historically always been a pricing cycle, and that there has been a catch up in that cycle over the last several years. And really where we're at right now, what we talk to our clients about is we're at this place where that catch up has happened. But how do we then stay with the trends? How is it that we try to make this sustainable for both the insurers and the clients, and work together in order to really try to hone in on the accuracy of our estimates on both sides, so that we have a really well-functioning relationship together. And that's then that goes to a lot of the heart of our conversations these days.
Yeah, that's great. Thank you. Some very exciting things going on from a technology perspective. I mean, we were in here talking about RDS not very long ago. It's very a lot going on that side, and things that you're supporting clients with, I think. Yeah,
I think the transparency that we talk to our clients with these days is something that I don't think was probably normal a generation ago. And we work with our clients as in RDS. Really, we're talking, it's their data. RDS is a platform that they put their data on that helps them understand their risk across the globe. We also put our information that we have as far as how do we cost risk. You can get down into the detailed conversations with them around what part of their risk is driving our assessments and the why. Really, that part of it is something that I think the insurance industry struggled with transparency in the past, and we're really trying to work on that, and it makes for interesting conversations.
Oh, very good indeed. And Tamas, for you, just technology also exciting, I think, from a life and health perspective, Life Guide being one example, I suppose.
Yeah, well, so for us, certainly a very exciting example of deploying AI, out in practice with some of our clients. So life and health is it's one of the most manual of the insurance areas, and for good reason. There's a lot of life-by-life processing around medically underwriting risks, and then carefully assessing claims when they're paid out. So it's all really, really important work. But really the experts in those space would rather spend more of their time on the high expertise and high knowledge topics than on the more administrative elements of those processes. So there are clear areas where they can be automated. So automation was one kind of phase that the markets went through on medical underwriting actually a couple of decades ago, but improving all the time, and claims is still to come. We saw one opportunity to deploy some of the potential benefits of AI that we see on Life Guide. So that's something we call Life Guide Scout. That's out being piloted with some of our clients at the moment. And there's, to mention it in just a nutshell, Life Guide is effectively the expert manual that medical underwriters will look at when they see disclosures from potential policyholders to then determine what the appropriate underwriting steps are, whether it would be an adjustment to premiums, whether they're standard lives, or whether there's some kind of other action that needs to take place. And it's a repository of a huge amount of knowledge, and using generative AI to be able to more quickly sort through the knowledge and put to the fingertips of our clients, underwriters, what they need to know to then make a decision, saves a significant amount of time. And there's hundreds of thousands of hits per annum that our client underwriters make for some of our larger clients. So something that saves a small amount of time in the process will already pass on efficiency gains. I think over time, I'd expect to see that expand as well to suggest ratings, for example, that then would still be agreed and ratified by human underwriter, but with the advantage of AI helping with consistency and speed of efficiency to get to those kind of decisions. So I think there's a lot of opportunity there.
Very good. All right, Tamas, thank you very much indeed. Well, I think it's coming to the time for audience questions. I'm going to wait for those to pop up on the screen if we have any. If not, I shall take moderator's privilege to ensure that I can ask something first as well. Kera, perhaps you first. We've largely talked about the developments and trends in advanced markets. What about in emerging markets from your perspective?
It's an interesting question. We found, we do a lot of analyzing the various loss trends across the different markets. We find, honestly, property is property, right? So whereas there used to be, some real differences across the regions, these days we find those differences are closing across the regions. And so there we're moving to, we still very much try to get down into the very specifics of each individual risk. At the same time, we are aware of global trends there, and global counts more than regional in some cases. On the liability side, obviously, that's far more localized. And in the emerging markets, what we're seeing is we're starting to watch for some of the trends from some of where you've taken more of the developed markets. Right now, we're not seeing those trends as much in the developing markets, but we're watching to see. There are Australia moves differently than Singapore, obviously, right? And I think some of those, it's so diverse as a landscape out there that really, unless you, on the liability side, unless you're down into the details in the individual markets, I'd say it's a dangerous place to be unless you know each individual one.
Right, and then I think my understanding from the P&C reinsurance market, and as a communications person, I hesitate to delve too far in that, but things like parametric making a really big difference on getting access and supporting emerging markets on that. Are you seeing that too?
Yeah, we find there's a lot of interest on the parametric side. And really, it goes when I talked earlier about some of that fine tuning of the risk transfer, right? It allows clients to when we talk about parametric, if there's one certain element that they want to cover, they can take that out and they can say, give me cover for this only. The other thing about the parametric side that interests our clients a whole lot is really just the speed of payment afterwards. How quickly will they have that money in their account in order to then start taking loss mitigation actions? How that kind of certainty around it and the speed. it can be hours you count, those kind of things. That is very interesting, and it goes to the real fine-tuning that's happening out there in the market today.
It's very it's to what you were saying originally about sort of technology and a lot of change, but also a lot of technology that's enabling us to do more with that. Let me come to you, Tamas. I mean, you've touched already a little bit on Middle East Africa within your purview. Are you able to tell us a bit more about the emerging markets more globally than that?
Yeah, so I think some of the same challenges and opportunities really lie within those. So one of the really important notes that I picked up early on is I mentioned the moving along the S curve, right, which sounds a bit nerdy, but the graphs are all there in the World Insurance Report, and that's whereby we expect to see as the economy develops. So particularly for life and health business, it's really intrinsic to a developing economy what role the life insurance sector plays in that, and as the market develops and increases in GDP growth and GDP per capita growth, not only does the penetration also tend to improve, because the sector of society that's more middle class has more disposable income and more assets to protect from life and health. They need more resilience. There tends to be a higher spend, and then what we also see tend to evolve is the actual products that are provided. So if you look at some of the developing markets for life and health, and that's the same, be it LATAM, be it Middle East, be it in emerging Asia, the products tend to go through a path of development suite as well, and they're looking at the advanced markets to incorporate that. So towards the more advanced end, you tend to get longer and longer dated products, so that have whole of life type guarantees, sometimes starting to get to more complex health risks, so critical illness type policies, and also those similar to income protection or kind of disability income, where you really need quite a complex and advanced web of insurance, medical provision, rehabilitation space for that to become an insurance offering. But it's often covering one of the most important areas of household resilience. So as we see those markets around the world develop, not only do we forecast increase in GDP, increase in life insurance premium growth overall, but then really an increased role that insurers will play in those markets.
All right, very good, very good. Thank you, Tamas. Kera, just getting to the questions here, and thank you to everyone who's asked a question. Remember, you can go to slido.com, and it's WIS 2024 to ask your question. I'm going to come to the second one here, actually, Kera, if I may, with you first of all, about geopolitical risks. And I think some of this is being driven by some of the economic disenfranchisement that we've discussed about. We've had recent votes in Germany, for example. Tell us a little bit about geopolitical risks on the corporate side.
Yeah, so geopolitical risks, there's a couple of different elements that would go along that would be, I'd say, top of mind when we talk to people. I mean, first of all, supply chain, right? As we are more interconnected, and as a lot of the corporates that I work with are spread all over the world, it's what is the impact to your supply chain based on everything from shipping routes and whether they're accessible to whether or not the money flows between them and their suppliers as smoothly as it has in the past. So I'd say there we should be very vigilant, right? We are a highly interconnected and highly fine-tuned as far as trying to minimize cost, I'd say, economy today. And a little bit of change will drive a lot, right? There's metrics out there that say that the anticipation should be that it's up to 6 months supply chain interruption that many of our clients should expect in one of their primary suppliers within that next 10-year time span. That's a lot, right? So there we should be concerned. The heightened risk that comes with strike, riot, civil commotion is elevated. That has gone up, as far as frequency goes, somewhere in the 3,000% over the last couple of decades. And this is a huge change. And I think you're right. It comes with the disenfranchisement of portions of our community. So these are very much risks that matter, and something that we should be aware of, especially in this year of global elections. These are these could signal significant regime changes in many of the jurisdictions out there.
Yeah. Again, goes to our the sort of the resilience that we bring to the world and the sort of shock absorbing role that we have as well. Tamas, geopolitics, life and health.
Well, it's a fascinating year for geopolitics. Right? I think more than half the world are voting this year, have voted or are expecting to vote. And some of those in markets where it really makes a significant difference. So we saw that already, looking back throughout this year in both in India, in South Africa, in the EU, in France, in the UK, still to come in the US. I mean, in one example there, I'd say for South Africa, it's widely seen to be an outcome to the election which is business friendly and has been seen positively from the insurance sector. So there's lots of opportunity for ongoing development there, and I think it's really important the political support for the industry. And I would say, similarly in the UK, perhaps not an unexpected outcome to the election. So the industry was already well on top of the, what direction a new government may take, what role the private sector would have to play in that. I think it's, there's certainly an increased focus on the need for an improvement in the overall economic environment around here. And I think when you look at the role that household resilience, that personal savings, that health has within that, I think there's wide open spaces for the sector to play.
All right, thank you very much indeed, Tamas. And then, Kera, I've got a question here. The cost of capital is a short-term measure. Value creation is a longer-term output. Is the mismatch coming down?
Yeah, so cost of capital is short term. At the same time, what we are here for as an industry is to absorb risks, every now and then. That means that we will not make our cost of capital at times. Right? That is acknowledged. At the same time, if we don't meet the needs of both investors and then the economic world out there, then honestly, as an industry, we're not very sustainable. And so I think the mismatch is coming down, but we need to make sure that we stay we as an industry stay out there, as I've said before, in front of the trends in order to make sure that basically this remains kind of steady as possible going forward.
Okay. Very good. I think we'll draw that to a close. Kera, thank you very much indeed for your insights, obviously from the corporate side, and Tamas Bown, obviously thank you also from the Life and Health Reinsurance. Thank you very much indeed for your help. And to you, of course, the audience, we will place the recording online and you can find out more and obviously read the World Insurance Sigma online. To those of you who have attended, we will also send you an email with the link to the recording and the report itself. So thank you very much indeed, and see you soon.